Okay, we still have a few more basics to learn about bonds. And one of them is we have talked about a bond's price. Okay, we said the price of the bond, the price of the bond. Well, there are two prices to every bond. In fact, really for all financial assets, this would be true, but it's a little bit more evident for bonds. The two prices are the ask price and the bid price. Now, the way I would suggest that you try to remember this is that if you order them alphabetically, ask, bid, the ask price is always higher than the bid price. That will always be the case. Ask, bid, the ask price will be higher than the bid price. The ask price is the price at which a bond dealer is willing to sell a bond. The bid price is the price at which a bond dealer is willing to buy a bond. See, bonds are traded what we call over the counter, which means they're not traded on an exchange like the New York Stock Exchange or something like that. They are traded amongst bond dealers. So bond dealers will post quotes. They'll say, hey, I'm willing to buy this bond at such and such a price, and I'm willing to sell it at such and such a price. Kind of like a used car dealer, right? A used car dealer will buy a used car, okay, at one price, then they will mark it up and sell it at a higher price. So there's two prices to that car: the price at which the used car dealer is willing to buy it at, and then the price at which they sell it at after they mark it up. So bond dealers work the same way. The difference between that ask price and the bid price is called the spread. And the spread is the compensation that the bond dealer makes for providing liquidity to the market. Liquidity in the sense that if I want to buy bonds, it's very easy to do so because there are bond dealers who have bonds that are willing to sell them to me all the time. If I want to sell bonds, it's very easy to sell my bond because a bond dealer is always willing to buy it from me. So these bond dealers have to be compensated somehow, and the way they do it is they have learned the most important rule of finance. Now, this is important here, okay? If you're getting a degree in business or finance, this is the one thing you need to know above everything else. Buy low, sell high. That will ensure financial success. Buy low, sell high. Well, easier said than done, right? But that's what a bond dealer does. A bond dealer buys at the bid price, which is the low price, sells at the ask price, which is the higher price, and that's how they make money. Now, you and I, unfortunately, if we're not bond dealers, when we see the bond dealer advertising an ask price, we know that's the price we're going to have to pay. And we see them advertising a bid price, we know that that's the price we're going to receive if we sell the bond to the bond dealer. So that's kind of important there. The next thing we want to be aware of is that government bonds, treasury bonds, sometimes, I should probably even say often, okay, are quoted in 30 seconds. Now, when I say 30 seconds, I don't mean halfway around the clock. I don't mean units of time. I mean something over 32. So if you see the price of a treasury bond as being 101 with a colon or a dash, and then the number 16. So 101 colon 16 or 101 dash 16. What it means is the price is 101 and 16 30 seconds. Now, 16 30 seconds is a half or 0.5. So it'd be 101.5. If you see a decimal point, it means the same way as decimal points always mean. Okay, the numbers after it are in tenths and then 100ths and so forth. But if you see a colon or you see a dash, when we're referring to treasury bonds, that means the number to the right of the colon or the dash is 16ths. So I'm sorry, the number to the right of the colon or the dash is going to be in 30 seconds. So if you see a bond priced at 98-20, that means the price of the bond is 98 and 20 30 seconds percent of the face value. Remember, we're always talking about percent of the face value when you hear prices of bonds somewhere around 100, a little bit above 100 or a little bit below 100 there. Okay, so let's take a look at some treasury bonds here. Would be a good time to do so. Now, these are not going to have a colon or a dash. They've already been converted to a decimal there. And This is going to be coming right off of the Wall Street Journal that I've got available for you, right off of the Wall Street Journal's website, I should say. So let me pull this up for us to be able to look at together. And okay. Yeah, this is what I want right here. Okay, so this is the Wall Street Journal's website, which is showing what is the bid price and the ask price for different Treasury notes and Treasury bonds. Now, it doesn't tell us whether the Treasury notes are Treasury bonds because, frankly, it doesn't matter. All we need to know is what are the remaining coupon payments and when do they mature. How long ago they were issued is not significant for us. So let's scroll down here and just grab one kind of at random. Okay, here is a Treasury note or a Treasury bond that is going to be maturing December the 15th of 2020. Okay, and I'm trying to get it so just that one is highlighted. Okay, so this first number right there, that is the coupon rate. 1.87, everything is in percentages, so that's 1.875%. Now, coupon rates always go in eighths. So you can see a coupon rate of 1%, 1 1/8, 1 2/8, which is 1 1/4, 1 3/8, 1 4/8, which is 1 1/2, 1 5/8, 1 6/8, which is 1 3/4, 1 7/8, and 2%. So 1.875% is going to be 1 7/8. That's the coupon rate, 1.875% or 1 7/8%. As you can see, we have got, and I've kind of scrolled down here a little bit already from up here, the bid price is listed first, and it's 100.092. The ask price is 100.096. So like I said, the ask is always going to be greater than the bid. This number right here, 0.002, is not going to be terribly important for us. That's how much the price changed from the prior day. Okay, so if you had been looking at this particular bond and how it was being quoted in the prior day in the Wall Street Journal, it has gone up the price has gone up by 0.002. And then the last number here, 1.51, that is the yield on the bond. 1.51%, and that is an annual number. And because you need to know the price of a bond to find the yield, we need to know which price is the Wall Street Journal quoting the yield based upon. And if we look up at the top, we'll see it's based upon the ask price because it says ask yield right up there. So we're looking at the coupon rate, okay, for any of these bonds, the bid price, the ask price, and the yield. So these are quotes from a bond dealer at a specific point in time, 3 p.m. Eastern time yesterday. These are what the bond dealer says, I'm willing to buy these bonds at, I'm willing to sell these bonds at. These are not necessarily transactions that have taken place. If we scroll all the way down to the bottom, we're going to see a bond that is going to be maturing on November the 15th of 2049. As I am recording this, that is going to be what we call the on-the-run 30-year Treasury bond. It is the most recently issued 30-year Treasury bond. 30-year Treasury bonds are issued a few times a year. This one was issued about November the 15th of 2019. That's when it was issued. So it matures November the 15th of 2049. There have, as I'm recording this, there have been no 30-year Treasury bonds that have been issued since then. So it is the on-the-run 30-year Treasury bond. On the run is significant because when you hear people talk about what is the yield on the 30-year Treasury, well, there's lots of 30-year Treasuries out there. They're referring to the most recently issued one. The on-the-run bond is a little bit more actively traded. It seems to be a little bit more in demand. And when you are developing a yield curve, which we'll be talking about later, that is typically done using one of the on-the-run treasuries or using all on-the-run treasuries. So that particular treasury bond has a coupon rate right now of 2.375%, which would be 2 3/8. The bid price is 107 2.1. Now, that's a pretty high bid price. What does that tell us? It tells us the price has gone up because interest rates have gone down. So as I'm recording this, we can see that interest rates have gone down between November 15th of 2019 and right now. Interest rates went down, the price of the bond goes up. And what is the yield on the bond? 2.042%. Now, if 2.042% reflects where interest rates are right now, as is typically true with the yield, where were interest rates when this bond was issued? Probably right here about at the coupon rate, 2.375%. So between the time the bond was issued and now, okay, when the Wall Street Journal is showing these treasury quotes, interest rates have gone down from 2.375% to 2.042%, 30-year interest rates. So the price of the bond has gone up, and that's a significantly high price there. All right, so if we scroll all the way up to the top here, we can click on the next page, okay, which is going to be looking at not Treasury notes and bonds, but Treasury bills. Treasury bills are all going to be maturing 1 year or less from the time they were issued. So if we go all the way down to the bottom, the last Treasury bill is set to mature January the 28th of 2021. And as I'm recording this, that is less than 1 year from now. So this would be the on the run 1 year Treasury bill. Now you notice for the Treasury bills, okay, where we had coupon rate for the Treasury notes and Treasury bonds, we don't have anything because Treasury bills do not make coupon payments. Treasury bills, you buy them at a discount, and then when you sell them, or I'm sorry, when they mature, you get the face value. So let's suppose the face value of a Treasury bill is $1,000. Well, if you bought it for $950, and then when it matures, you get $1,000, that's how you make your money with a Treasury bill, by owning it. You do not receive any coupon payments or interest payments. You buy them at a discount. Now, one of the things you might notice here about the Treasury bills is that it appears that the bid price is higher than the ask price. You look at this first one here, the bid is 1.465 and the ask is 1.455. But if you're particularly astute, you'd say, wow, those are weird prices. How do you get a price of 1.465 or 1.455? And that's because they're not actually prices. There's something called yield on a discount basis, which we will learn about later on, which are approximations of the yield to maturity. So this number 1.455 is an approximation of 1.479%, which is the yield to maturity. For decades, okay, and scores of years, for a very long time, this is how Treasury bills have been priced. We will learn later on why they're doing it that way, but Treasury bill prices are not quoted in dollars and cents. If you want to buy a Treasury bill and you want to figure out what's the price in dollars and cents, you're going to have to figure that out yourself. The dealer is going to tell you, hey, you want to buy it? The price I'm going to charge you is the ask price, which is 1.455. And you're going to need to be able to convert that to dollars and cents. But that's something called a yield on a discount basis. Now, the reason why the ask yield is lower than the bid yield is because the ask price is higher than the bid price, right? Because when yields go up, prices go down. When yields go down, prices go up. So if the ask price is higher than the bid price, then this asked yield on a discount basis for a Treasury bill is going to be lower than the bids yield on a discount basis. So that's coming off of the Wall Street Journal. Now there's another page on the Wall Street Journal where we can take a look at the yield curve. So let's go do that. This is the yield curve on the Wall Street Journal. Again, as I'm recording this, this is the current yield curve. And a yield curve is a graph that represents something called the term structure of interest rates, which is looking at what is the relationship between how long it is until a bond matures and what is its yield to maturity. So what we're going to see on this is the black curve is 1 year ago and the blue curve is current. So, excuse me, clearly interest rates have come down in the last year. And right now, a 30-year Treasury bill, 30-year Treasury bond has a yield to maturity of 2.0485%. We just looked at it, okay, just a second ago, the on-the-run 30-year Treasury bond. And so that is graphed here at 30 years and just a little bit over 2%. A 10-year Treasury note, the on-the-run 10-year Treasury note, currently has a yield of 1.5836%. There's a 5-year Treasury note. There's its yield, 1.406%. There's a 3-year Treasury note. These are all the most recently issued of these. 2-year Treasury note. Here's a 1-year Treasury bill that has a yield of 1.4904%. Again, we just looked at that a little while ago. Here is a 6-month Treasury bill. It matures in 6 months. There's a 3-month Treasury bill, and here's a 1-month Treasury bill. It matures in 1 month. We don't go down to zero. So what we've got here is different times to maturity on the x-axis, and the yield to maturity is on the y-axis. I know we're used to seeing the numbers on a y-axis off to the left. I don't know why they put them off to the right, to be honest with you, but they do here. So what we're seeing here is that short-term interest rates are lower than long-term interest rates. But frankly, these midterm interest rates are lower than the short-term rates. That's not typical, okay? What is typical is that interest rates go up or get higher as we expend maturities. That's what's called an upward sloping yield curve. An upward sloping yield curve would be something a little bit more like what we saw a year ago, that the lowest interest rates are going to be short term and the highest interest rates would be long term. A flat yield curve would be one where they're all pretty much the same. And really, this is not that far off from being a flat yield curve. And a downward sloping yield curve would be where short-term interest rates are higher and long-term interest rates are lower. We're going to be talking about this more extensively a little bit later on as we delve into bonds in more detail. But for right now, I just want you to understand that a yield curve is a graph that is showing the relationship between a bond's time to maturity and its yield to maturity. That bonds that are going to be maturing in a relatively short period of time, this is what their yield is. This is what short-term interest rates are. A bond that will be maturing a longer period from now, this is what the yield is. It's going to be, this is what longer-term interest rates are. And usually, that's an upward sloping curve. Sometimes it's downward sloping. Sometimes it's flat. The shape of the yield curve tells us a lot about what investors are expecting to happen in the economy in the future. It doesn't tell us what's going to happen in the economy, okay? We need a crystal ball for that, but it does tell us what investors are expecting to happen for the economy. And again, we'll go into that in more detail later on. Now, the last thing I want to talk to you about with bonds are bond ratings. So let me pull that up here for you. And here we go. That there are a number of different rating agencies, okay? The two most well-known are Moody's and Standard & Poor's. They're not the only two, but they're definitely the most well-known. And they will rate bonds based upon the ability of the bond issuer to make the scheduled, or what they perceive as their ability to make the scheduled coupon payments and the face value. So Moody's and Standard & Poor's will research very carefully all the financial conditions, the market conditions, and everything else about anyone who issues bonds and make an evaluation, which is a guess on their part, okay? It's a forecast of how likely it is that the bond issuer is going to be able to make the payments. And the bonds that have the highest rating, Moody's and Standard & Poor's are saying the bonds that have these ratings are the least likely to default, okay? They're the most likely to make all the scheduled payments. The bonds that have lower ratings are going to be more likely to default. They're not saying for an individual bond that this bond will default or this bond won't default. what they're saying is their top category, which is for both of these, we call them AAA bonds, that these are the least likely, that they're going to have the smallest percentage of defaults. The AA bonds are going to have a little bit higher percentage of default, okay, than the AAA. The single A bonds will have a little bit higher percentage of default than the AA. Then you got the triple B, and I call them all triple B, even though Moody's it's BAA, and they're very similar, but they've got a little bit different labeling system. And then we can go all the way down to the single C. But we've got AAA, AA, single A, triple B, double B, single B, triple C, double C, and single C. Now, both Moody's and Standard & Poor's have modifiers. For Moody's, the modifiers are 1, 2, or 3. Now, neither of them have a modifier for AAA. If you're AAA, that's the best rating you can get. But for example, for AA, okay, Moody's will have a AA1, a AA2, and a AA3. Standard & Poor's uses pluses and minuses. They'll have a AA plus, a AA, and a AA minus. Okay, and the same thing for single A, triple B, and so forth. So when you are looking at some actual bond ratings, and down at the bottom of this, we're going to take a look at some actual bond ratings, you will see those modifiers on there as well. Now, there is a very important line in between triple B and double B, okay? Any bond that is rated triple B or better is considered to be an investment grade bond. It's called an investment grade bond. Any bond that is rated double B or lower has a few names for it. Non-investment grade bond, high yield bond, junk bond. They all mean the same thing. They all mean that they are rated double B or lower. Okay, it could be double B, single B, triple C, et cetera. Now, it doesn't necessarily mean it's a piece of junk. It just means in Moody's and or Standard & Poor's opinion that they have a higher probability of defaulting. The ones with the higher ratings, they have a lower probability of defaulting. So all else being equal, you're going to find the bonds with the highest ratings will offer the lowest yields, because investors, remember, are risk averse. So in order to entice you as an investor to buy some of these lower rated bonds, which have more risk, what do they have to offer you? They have to offer you a higher expected return. So a junk bond, you know, if you buy it and it defaults, it truly was a piece of junk. But suppose you buy a double C bond and it makes all the payments exactly as scheduled, then you're going to have earned a much higher yield than you ever would have earned, say, with a double A bond. And so that was a really astute investment on your part. But you went into it, hopefully, knowing that there was a higher probability that it would default as a double C bond than it would have been as a double A bond there. So that's the ratings of the bonds. I've also got here a few well-known companies and what their bonds were rated. But I got to let you know, these ratings are a little bit old. They were from around 2010. I had a student at that point in time who used to work for a bond dealer who could get me this information. You know, I've lost track with that particular student, so I don't have any updates since then. But around at somewhere around 2010, these were some ratings for some well-known bonds. In each case, these were bonds that were due to mature in about 30 years. I happen to know some of these companies, their ratings have in fact changed, but just kind of gives you an idea for some reasonably well-known companies what their ratings were there. Okay, so that's some information on bond ratings. We're finished at this point in time with the basics on bonds. We're going to get into more detail on a lot of the things dealing with bonds in some future videos.